In the second module, we would look at GDP when the numbers are announced and compare the actual with the expectation. Well, it's important that we remember that when we look at this data, we're looking at real GDP. And real GDP is equal to nominal GDP minus inflation. Right? Why is this important? Well, this is important because if you get a pay rise of 3%, is that good or bad? Well, it depends on inflation, right? If inflation is 3%, right, and you have a 3% pay rise, then what are you really getting? You're really getting nothing, right? So when your boss walk past by you, you can say, "Hey, boss, thank you for giving me a zero pay rise," right? Which is great. Which is great. Why? Because if the company had paid you a 2% pay rise when inflation is 3%, then you are really getting a pay cut, right? So this is why we look at real GDP. Right? You will see that the GDP number, when it's announced, it comes out in the form of quarter-on-quarter annualized. So we are looking forward to Q2 over Q1, right? Annualized. So Q2 over Q1, like roughly multiplied by 4, give us the annualized real GDP rate. Right? Well, sometimes when we hear the word recession, and where does this come from? Well, this is actually determined by the people at the National Bureau of Economic Research. And their definition of GDP is different from sometimes when you read in the media, when we have 2 straight quarters of negative growth rate, and the media will say, "Oh, we have a recession." Well, no. The NBAR, they look at employment, income, retail, and wholesale sales, right? And they're very careful with their numbers, right? And they typically wait for enough certainty with the data collection, and sometimes they may wait for data to be revised before they come out and tell us that the recession started on that particular day, right, month, right, 3 or 4 months or 6 months ago, right? And typically, right, by the time they announce it, right, the recession is ending soon. Okay, so do not trade, right? Do not go ahead and sell stock the moment you hear the NBER saying that we are in a recession, right? Because by then it's already all in the news. But nonetheless, their work is very important. Why? Because their work gives us that the bar chart, the gray bar chart that we see in our economic research, right? And that helps us to do a very good analysis, looking into the past and see how certain stocks, say consumer discretionary stocks or energy stocks or bank stocks, how they had performed during the last few recessions. Right? And it's because the NBER, right, provided us with a very set month, right, when the recession started and when it ended, right? Okay, so it's very useful, right? And when you read the newspaper, right, bear in mind that the description is always something like real GDP is higher or lower than anticipated. Okay? Like, there's always the end. The last part there, higher, lower than anticipated, higher, lower than expectation. Right? So sometimes you may see that the number comes out at, say, minus 1.3% GDP, and the stock market will rally. And people say, this doesn't make sense, minus 1.3 and the stock market is rally. Well, when that happened, typically that minus 1.3%, right, had come in, right, better than expectation. So the expectation could be minus 2.5%, right, GDP. So minus 1.3 is better than minus 2.5%, 5 GDP, right? And therefore the stock market, right, would rally, right? Well, what else? Well, so the question now is, right, where does this anticipated come from, and where is the survey coming from, right? So the anticipated number, or the average, is the average of the survey, right? So companies like Bloomberg, Wall Street Journal, they would survey the top economists in the country, right? So this could be economists from the sell side, buy side. They could also be economists, famous professors, right? And they could be economists that are working in independent research firms, right? And I like to think that their forecast is unbiased. It's unbiased because at the end of the year, these Bloomberg and Wall Street Journal would rank these economies based on how accurate they are, right? So surely, right, none of these economies want to be at the bottom of the list, right? Because if they're at the bottom of the list, they may be fired, right? At the same time, if they're top of the list, then they can have a bigger following of clients who want to read their papers, and therefore they are likely to get a large bonus from their company, right? So we pay a lot of attention, right? To the forecast, right? Because the market would act, right, on the numbers that is higher or lower than the forecast, like positive or negative surprises, right? So here you have this U.S. economic surprises, and we have the bond yield, right? What are we looking at? Well, as you can see from this history, right, that whenever the economic surprises is higher, right, when the economic surprises is positive, that means numbers are coming in better than expectation. The bond yield will go up. And bond yield will go up because when the economy is better than expected, analysts, investors would expect more inflation coming down the road. If you expect more inflation, then interest rate will go up, right? At the same time, the impact on the stock market is also very significant. Right here, you can see that when the economic surprises is negative, then the stock market comes off, right? When it is positive, the stock market will go up, okay, right? Because, right, if the data is showing the economy is stronger than expected, we have to revise our model. That means that we should expect this company to have higher than expected revenue and profit projection. So we revise our model, and the S&P 500 would trade up. Okay. All right. So let's look at recession, right? How long after recession does real GDP return to its previous peak? Okay. You will see that in the previous recession, we have a rather quick response, right? But this 2007 and 8 recession took a long time, right, to recover. What's the possible reason behind this? What's the possible reason behind this? Well, I think that in the past, when we have a recession, that's because of imbalances, right? We have overinvestment in certain industry. So the recession would happen, right, to flush out all these mistakes, right? So companies will go bankrupt, and when companies go bankrupt, the labor force is free to move to other more productive area, and the company that make mistake, they die, right? And their space is open up, and some other companies that are more competitive will come in, right? So we rebuild, right? In this 2007 and 8, right? There are many research showing that what happened is we didn't let this company die, right? We keep them alive through low interest rates, and basically we are just allowing these zombie companies, right, to hang around, right, to hang around. And because we didn't have a total flush out, right, the underlying problem is still in the economy, right? So that's why it takes such a long time, right, for us to for the economy to recover or the lost ground. Right? So yes, since 1950, the average is 6 quarter, right? And the large variability, and this variability forces us to think through, right? Right? What it takes for the recession to recover, right? And the answer is, right, it depends on what causes the recession and what kind of policies are implemented to, 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 to mitigate the recession. So, so the one thing that you want to remember is that in 2008, right, we have created a lot of zombie companies. Right. So the one quick thing here is what is the walking dead of economics? Well, the answer is QE. Quantitative easing has created the very strange situation that we are now in. Well, the reason why we want to study recession is that recession would lead to, would be accompanied with a sell in the stock market, right? Okay. So in the past experiences, we see all these gray bars here, right? So all these are the NBER recessions, right? We see the recession here caused by fiscal tightening, right, and the Vietnam War, right? And over here we see the Iranian oil crisis and the monetary tightening. Here we see another monetary tightening, and here we see the tech bubble burst, and here we see the global financial crisis. So the days where we have a tight fiscal, tight monetary policy that create a recession seems to be replaced by excesses. Excesses in the stock market and excesses in the leverage, in the financial stocks, right? That the, uh, the excesses created the recession that we have seen in the last two periods. Right? So what causes recession? Right? Okay. Another way to look at this is to look at the previous history. Right? As I mentioned briefly just now, when we look at the last two recession, we can see that very clearly here, we have too much investment in housing in 2008, in IT 2001, and commercial real estate in 1990. Right? How do we then compare this COVID-19 crisis? Right? Surely it's not uh, uh, less connected to too much investment. Right? The one very good comparison is the 1919 pandemic flu, in which 5% of the population died and 1 out of 3 people got infected. Okay, right? And we can see that the recession was rather brief, right? 7 months, right? 7 months, right? One argument is that unlike the recession caused by too much investment, this takes time. This takes time to unwound the excesses. It takes time. Whereas in a disease-related recession, what we have is a quick shutdown, whether it's implemented by government or people are just too sick to go out, and two people are just dying, right? Once the worst is over, whether we find the vaccine or whether we have crowd immunity, then the economy will bounce back, right? And there's not a lot of infrastructure that's damaged. There's not a lot of infrastructure that damaged, right? So conceivably, yes, now not many people want to fly, but the airlines are merely right putting the airplanes aside. Right? They're not destroying the airplane. They're putting it aside. And the moment things are under control, right, it's not difficult for the airlines to bring back the planes and people will fly again for businesses and tourism, etc. Right. Now I want to move on to a very important section where we understand how we look at the data, right? And you can see, as I mentioned briefly just now, the US real GDP growth, right, okay, is announced on a quarter to quarter okay, basis and annualized. So as I was saying just now, we are looking forward to Q2 over Q1 GDP, and the number will be annualized. Right? So you can see that the reported data is a very volatile number. Right? Obviously, right, because when we look at Q2 over Q1, we can understand there's a seasonal distortion, right? Because in Q1, that's when we have the bulk of our winter, right? Less spending. Q2, right, we are getting into summer, and that's where we have a lot more spending, right? So a lot more spending over a period of less spending multiplied by 4 to annualize it, right? We are exaggerating the seasonal effect. Okay. So what do we do? Well, a better way to look at the US GDP number is to look at the 12 month, okay, the 12 month or the quarterly, right, Q2 over last year's Q2, right? If we look at the Q3, then we look at this year's Q3 compared to last year's Q3, right? So this way, when we compare Q3 with Q3, we are removing the seasonal effect, right? So I prefer looking at data this way, and it is also less volatile. Okay? And it's also easier to try to figure out the range of the growth or the average growth, right? Okay, on a year-on-year basis. Okay. All right. Well, on this chart, I'm showing you both. I'm showing you the bar chart, which is a Q and Q annualized, and the green line, the year-on-year, right? So as you can appreciate, when we focus on the year-on-year, we see the decline here, and we see the rising trend here and the downtrend here, right? A lot easier than looking at the bar chart, right? So should you use Q on Q analyze or year on year? Well, it depends. I think for most of the, hang on, for most of the time, if you're just looking at the trend of the economy, yes, we should look at the year on year. But if you are comparing the revenue of, say, Apple or Google, right? And if Apple or Google announce their revenue on a quarter-to-quarter basis, then you want to compare, right, their quarter-to-quarter numbers with the quarter-on-quarter GDP number. So this concludes this segment for here.